Hello and welcome. Come 2026, selling off a valuable asset could cost you almost a quarter of your profit in tax. But what if I told you there's a way to get the cash you need for just a fraction of that cost, without actually selling a thing? Well, that's the strategic shift we're looking at today, and it's all based on some brilliant analysis from the trusted UK firm, My Tax Accountant. A very unique financial environment is taking shape, and it really does demand a new way of thinking about your wealth.
Right, let's get straight to the point. Imagine you need some cash. In 2026, your choice is going to look something like this. On one hand, you can sell an asset and immediately watch almost a quarter of your gain vanish to the taxman. Or, on the other hand, you could borrow against that exact same asset for a fraction of the cost each year. This really stark contrast is the paradox we're going to be unpacking. It's a choice between a permanent loss of your capital or taking on temporary and, frankly, pretty affordable debt.
And it's so important you know this isn't just some theory we've cooked up. The insights we're sharing with you today come directly from the expert tax advisors over at My Tax Accountant. Their deep dive into this changing financial landscape is the backbone of everything we're about to cover.
So here's what we've got on the cards. We'll kick off with the 2026 tax paradox, then we'll look at the huge new squeeze coming on inheritance tax. After that, we'll explore a much smarter way to get your hands on cash, run through 4 practical borrowing strategies, and then finally, help you figure out your next move.
Okay, first up, the 2026 tax paradox. This is all about getting our heads around the unique financial world we're stepping into and why it's forcing us all to rethink strategies that have worked for years. So what's actually happening in 2026 is you've got these two powerful opposing forces meeting head-on. On one side, you've got the high cost of selling an asset. Capital gains tax is at 24% for higher-rate taxpayers. That's a big chunk of your money, gone instantly. But on the other side, the cost of borrowing is actually falling. The Bank of England base rate is at its lowest since 2022, and a lot of economists think it could drop even further. This creates what the experts at My Tax Accountant are calling a strategic window for anyone who owns assets.
Now, this tax paradox leads us straight into our next critical point, the new inheritance tax squeeze. And honestly, you'll want to hear this part, because this change is going to affect the very foundation of succession planning for countless family businesses and farms all across the UK.
You know, this isn't just a rhetorical question. For decades, so many families have built their entire legacies on the idea that their business or their farm could be passed down to the next generation completely tax-free. Well, that fundamental assumption is about to change big time.
Let's break this down, shall we? Before the 6th of April 2026, reliefs for farms and businesses were pretty much unlimited. A qualifying £10 million farm could pass on with absolutely zero inheritance tax. But from that date, that 100% relief gets capped at £2.5 million. Anything over that only gets 50% relief, which means the rest gets hit with an effective tax rate of 20%. It is a massive, massive shift.
So, what does that mean in cold, hard cash? Well, let's take a simple example, a qualifying family business that's valued at £5 million. Before April 2026, the IHT bill would be zero, zilch. After April 2026, that same business could be looking at a potential new inheritance tax bill of £500,000. That is £500,000 that needs to be found, usually from a family asset that isn't exactly easy to sell.
And as the team at My Tax Accountant points out, this is precisely the bit that catches so many people out. It's the sudden appearance of this enormous bill on an estate that everyone thought was completely protected. Planning for this new reality? Well, it's not really optional anymore. It's absolutely essential.
And that brings us neatly to the solution. If selling assets is creating a tax problem and the IHT changes are creating a cash problem, well, we need a smarter way to get cash. And this is all about a fundamental shift in how we think, from just selling our assets to actually leveraging them.
The main tool we use for this is something called securities-backed lending, or SBL. You might have also heard it called a Lombard loan. In really simple terms, it's just a loan that's secured against your existing investment portfolio. You're not selling your shares or your bonds, you're just using them as collateral to unlock cash, which means your long-term investment strategy stays completely intact.
Let's make this really simple. Imagine you need £200,000. If you sell assets to get it and you're a higher rate taxpayer, you could be staring at an immediate tax bill of £48,000. Poof, that money is gone forever. The alternative? You could borrow that $200,000 against your portfolio. The interest for the year might be around £9,000. The financial logic here is just compelling. You keep your capital and you pay a totally manageable fee for the cash.
Okay, so the theory makes sense, right? But how does this all work in the real world? In this next section, we're going to explore 4 specific, practical strategies for using asset-backed borrowing really effectively in 2026.
So we're going to look at using borrowing to fund lifetime gifts, to get cash without triggering tax, to handle a very specific charge for former non-DOMs, and finally, to pay for some really essential IHT insurance.
All right, first up, lifetime gifts. With that new £2.5 million IHT cap looming on the horizon, being proactive has never been more critical. Gifting assets during your lifetime is a really powerful way to shrink the final value of your estate.
And this is where the 7-year rule becomes so crucial. When you make a big gift, it's what's known as a potentially exempt transfer. Basically, if you live for 7 years after making the gift, it falls completely outside of your estate for inheritance tax. By borrowing cash to make that gift, you can start the clock on that 7-year countdown without having to sell off a chunk of the family farm or business. And even if you pass away within that window, something called taper relief can still reduce the tax bill quite a bit from year 3 onwards.
And here is a fantastic tip from my tax accountant. Before you do anything at all, get a professional, up-to-date valuation of your assets. With these new 2026 rules, knowing exactly where you stand against that £2.5 million cap is the absolute first step in any decent plan. Now, our second strategy is maybe the most straightforward, but it's a biggie. It's simply about getting cash for whatever you need, a property purchase, a business investment, anything, without getting hit by that huge tax bill. Cashing in a £1 million gain costs you £240,000. Borrowing against that same million keeps your capital in the market where it can continue to work for you.
Strategy 3 is a bit more niche, but it's vital for those it affects. Former non-domiciled individuals have a special window, the temporary repatriation facility, to bring old foreign income and gains back to the UK at a flat tax rate of 12%. But you need the cash to pay that charge. So borrowing against those same offshore assets gives you the money to pay the 12% tax. This effectively cleans that capital, so it can be brought onshore and used here in the UK with no more tax to pay, all without having to sell the underlying investment.
And finally, strategy 4 is all about funding the ultimate safety net, insurance. With IHT bills set to climb, a whole-of-life insurance policy, written in trust, can provide a tax-free lump sum that your family will need to pay the tax bill without being forced to sell family assets. The only snag is the premiums can be pricey. Using an asset-backed loan to cover these annual payments can be a really efficient way to make sure that vital protection is in place.
So we've covered the problem, and we've looked at the potential solutions. Now it's time to talk about planning your next move. This is all about taking these ideas and turning them into real, rational choices for protecting your own wealth.
Look, the most important thing is to be proactive. Here's a simple checklist to get you started. First, get that valuation done. Second, dust off your will and succession plans. They were almost certainly written under the old rules. Third, have a real think about your family's future cash needs. Fourth, talk to a professional about how asset-backed borrowing could work for you. And finally, remember the clock is ticking. Acting before that April 2026 deadline could make a huge difference. Now, of course, we have to be very clear about this. This information is for general guidance. Tax law is incredibly complicated, and everyone's situation is unique. So this is no substitute for proper professional advice, and you really shouldn't rely on this information alone to make your financial decisions.
So, we'll leave you with this final thought to mull over. In the new financial world of 2026, with high taxes on selling and lower costs for borrowing, maybe the most valuable asset you have isn't just what you own, but your ability to cleverly and efficiently use it.
To navigate these complex changes and to talk about your specific situation, we really do encourage you to get in touch with the experts who put all this analysis together. You can reach my tax accountant on 0208-570-8531, or you can email them at info@mytaxaccountant.co.uk. And for more insights just like this, please be sure to subscribe to the My Tax Accountant YouTube channel. Thank you so much for your time,